correct health insurance coverage can avoid bankruptcy. The wrong health insurance coverage could bankrupt you and your family. In this video, we will detail all the different types of coverage and how you can strategically incorporate them into your personal plan. Here's how conventional marketplace health insurance works. Imagine you have a $400,000 heart surgery, which is a covered medical expense under your health insurance plan. Then, let's say your health insurance plan has a $5,000 annual deductible with a 20% coinsurance and a $9,550 maximum out-of-pocket limit. From $0 to the $5,000 deductible, you must contribute each year before your health insurance plan starts to pay for covered medical expenses. So, for your $400,000 heart surgery, you're now responsible for paying the first $5,000. After this $5,000 deductible is met, the insurance company will pay a percentage of the bill called coinsurance. Coinsurance is a cost-sharing requirement where you're responsible for paying a certain percentage, and the insurance company will pay the remaining percentage of the covered medical expenses. These can vary from 90-10, 80-20, 70-30, and so on until your maximum out-of-pocket or MOOP limit is reached for the year. In this case, the max out-of-pocket is $9,550, so you'll be paying an additional $4,550 to reach the max out-of-pocket. The good news is once you've met your out-of-pocket, every approved medical coverage expense is free for the rest of that calendar year. The bad news is that almost 70% of the country will have a very hard time coming up with $9,550 to pay this bill, proving that medical expenses are one of the leading causes of bankruptcy in the US. The bill for that heart surgery could give you a heart attack. So how do you protect yourself from financial hardship? We'll dive into the answer to that question. But first, could you please like, comment, share, subscribe, and hit the bell below? Let's explain some prime options and strategies most people do not know about that could help you prevent financial hardship for you and your family. Most people are not aware that there are supplemental health insurance policies that can assist in eliminating the high cost of deductibles and extremely high max out-of-pocket expenses. Here are the top 6 categories. Accidental medical expenses, critical illness and hospitalized sickness plans. These cover up to the maximum out-of-pocket costs. Accident-only plans. Critical illness plans. Accident and critical illness plans. Fixed hospital benefit plans. Short-term health insurance, and special health saving accounts. Number 1. Accident medical expenses, critical illness, and hospitalized illness plan. These plans cover up to the max out-of-pocket cost only, so in the heart surgery scenario, the patient would not have to pay any deductible or max out-of-pocket. Number 2. Accident-only plans. These are great plans for anyone who's active that may get hurt, maybe twist an ankle or break an arm or leg. Ladders are one of the leading causes of broken limbs. AME plans generally have a $250 deductible that eliminates the $9,550 max out-of-pocket. Number 3. Critical illness only plans. This policy is for most adults of all ages. As we get older, our bodies just don't respond as quickly. Also, heart issues, cancer, and other issues pop up. The coverage on these plans can go as high as several $100,000. In the case of the heart surgery scenario, the patient would not have to pay any deductible or max out-of-pocket, and could have some additional funds to pay bills like mortgage or rent, utilities, and monthly insurance premiums while recuperating. Number 4. Accident and critical illness plans. This combination plan merges both accident and critical illness. These are very cost-effective and can cover much more than the deductible and max out-of-pocket. This option would have helped heart surgery patient in the same way the critical illness only plan would have covered. The advantage of the combination plan is consolidating 2 supplementary policies with one bill and with possible lower cost. Number 5. Fixed hospital benefit plans. Also known as dollar first or zero deductible plans. A fixed hospital benefit plan is a type of health insurance plan that provides a fixed amount of coverage for each day a person spends in the hospital, regardless of the actual cost of the hospital stay. Under this type of plan, the insurance company will pay a premeditated amount for each day a person is hospitalized, up to a certain maximum number of days or a maximum dollar amount per day. For example, a plan may provide $5,000 per day for up to 10 days of hospitalization. For our heart surgery example mentioned beforehand, this plan could be paying most of the deductible and max out-of-pocket. Once the max out-of-pocket is met, the major medical plan then covers 100% of the bill. But here's the bonus. Fixed benefit plans do not coordinate with the major medical plan. Coordinate means one plan stops paying, then the other plan takes over. In this heart surgery example, once the major medical starts paying, the fixed benefit continues to pay, acting as an income protection plan. It's important to carefully review the terms of a fixed hospital benefit plan before enrolling, as the coverage and limitations may vary widely between plans and carriers, and many fixed benefit plans do not accept pre-existing conditions. These types of plans may be more appropriate for people who are relatively healthy and at low risk of requiring extended hospital stays, but who still want some coverage in case of unexpected hospitalization. Number 6. Short-term health insurance was originally created as a type of temporary health insurance coverage that is designed to provide individuals and families with temporary health coverage during gaps in insurance coverage. These plans typically provide coverage for a limited period of time, often ranging from a few months up to a year, and are generally less expensive than traditional marketplace health insurance plans. Some states have allowed short-term insurance to have up to 3 years in length, and other states only 3 months. These plans generally have less comprehensive coverage and may have lower deductibles, co-payments, co-insurance, and coverage amounts. Short-term health insurance plans provide coverage for basic medical services such as hospitalization, emergency care, and doctor visits. Some carriers also offer coverage with prescription drugs. These plans are health underwritten and will not cover most pre-existing conditions. It's important to note that short-term health insurance plans do not meet the requirements in the Affordable Care Act, or ACA, in the United States, and do not provide coverage for certain essential health benefits, such as maternity care, mental health services, and some preventative care. Short-term health insurance plans are a viable option for individuals who are between jobs, waiting for employer-sponsored coverage to begin, who need temporary coverage for other reasons, or to replace a high premium, high deductible, high max out-of-pocket plan. Number 7. There are various special health saving accounts like HSA, FSA, HRA, and HMA. An HSA stands for Health Saving Account, which are tax-advantaged savings accounts that are designed to help individuals and families save money for medical expenses. HSAs are available for individuals who are enrolled in a high-deductible health plan, or HDHP, and are designed to work in conjunction with these plans. These plans can roll over each year, which makes them a great long-term financial program. An FSA stands for a Flexible Spending Account, which is a type of tax-advantaged account that allows individuals to set aside pre-tax dollars to pay for certain out-of-pocket medical expenses, dependent care expenses, or other eligible expenses. However, it's important to note that FSAs are use-it-or-lose-it accounts, which mean that any funds that are not used by the end of the plan year are forfeited. An HRA stands for Health Reimbursement Arrangement, which is a type of employer-sponsored health benefit plan that is used to reimburse employees for certain medical out-of-pocket expenses. These plans are funded solely by the employer, and employees do not contribute any funds to the account. Instead, the employer sets aside a certain amount of money each year to be used to reimburse employees for eligible medical expenses, such as deductibles, co-payments, and co-insurance amounts. An HMA stands for Health Matching Account, is a product that you can own to protect yourself and your family from healthcare expenses that are not covered by your health insurance or Medicare. The HMA can be conveniently used to pay for most out-of-pocket medical expenses, including deductibles, co-pays, co-insurance, and pharmacy costs by simply swiping their HMA Medical Reimbursement Visa prepaid card at qualified medical providers. Remember the heart surgery mentioned at the beginning of this video? We're going to cover 6 options that could have been utilized beforehand to help save the patient money. But before we do, if you haven't already, please like, comment, share, subscribe, and hit the bell below. Option 1. Selecting another marketplace plan with a reasonable deductible and lower max out-of-pocket would have been an obvious choice, but the monthly premium might have become too high for the person to afford. Selecting a short-term plan would be a quick alternative if the person had no pre-existing conditions. Then incorporate any of the other options below, replacing the major medical with the short-term plan. Option 2. They could keep the current major medical plan and then supplement the deductible and max out-of-pocket with an accident, critical illness, and hospitalized plan, thereby covering the total out-of-pocket costs and saving themselves $9,550. Option 3. Keep the current major medical plan and then supplement with a critical illness plan that would not only cover the deductible and max out of pocket, but give extra payment to help cover additional living costs. If they had done a $50,000 critical illness plan, it would cover the $9,550 deductible and max out of pocket, and give an additional $40,450 to spend on living expenses while recovering from the surgery. Option 4. The patient keeps the current major medical plan and then supplement the deductible and max out of pocket with the combo accident and critical illness policy. This gives extra money to help cover additional living costs, like the critical illness plan mentioned in the last option. Option 5. Keep the current major medical plan and then utilize either the HSA, FSA, HRA, or HMA, which could cover the total out-of-pocket cost if you have enough money in the account. Option 6. Keep the current major medical plan and then supplement it with a fixed hospital benefits plan. This would create a zero-deductible health insurance situation. The fixed benefits plan would cover a majority of the bills until the major medical plan was activated when the deductible was met. Then the fixed benefit plan continues to cover the patient's co-insurance portion until the max out-of-pocket is met. Then, at that time, the major medical would cover 100%, and the fixed benefit plan becomes income protection for the person. As you can see, there are many ways you can avoid bankruptcy by employing strategic thinking and knowledge of the system. Liking, commenting, sharing, subscribing, and hitting the bell below will help us bring more of these money-saving gems to this channel. So, as you can see, having a health insurance strategist and mentor to protect you from financial ruin is a must. See you in the next video.